What's up, everybody? Hope everyone is being safe and sane and sanitary. As my good friend Tom Williams would say, we have another episode of the Chart Book here, live from the deck of a Imperial Star Destroyer in honor of NASA and SpaceX's imminent launch, recording this Friday at the end of May. So hopefully, fingers crossed, it's tomorrow. What do we talk about today? Today is a topic that's been much in the news. A lot of big heavyweights of the investment space have been weighing in. Obviously, with the events that have transpired this year, tail risk is a topic that's on everyone's mind. We're going to walk back. We wrote a paper on this in 2017. We've been managing strategies on this area for a while, but also wanted to take you back to the paper because we've actually hadn't talked about it that much on the podcast or anywhere else. So we're going to jump on a few of the ideas. First of all, you can find the paper as well as a lot of our books for free if you go to CambriaInvestments.com. You can download at least 4 of our books and all sorts of different white papers, including this one called Worried About the Market. So let's dive right in. So let me find it. There we are. All right. Zoom out. So as we think about a lot of the previous bear markets, the one back in 2000, which was after my favorite bubble, the dot-com, as well as the global financial crisis, those are some pretty big fat losses. On the indices, you're looking at stocks got cut in half, but individual names, if you go back to the financial dot-com bubble, Cisco lost 80%, Amazon lost 90%. And in this paper, we wrote, here's a few 4 signs of a potential turn in the market. The first being an aging bull. Again, this is in 2017, not even 2020, but you had this scenario where you had this long bull market, and this shows a bunch of them over time. This is from Bloomberg as well as Wells Fargo and shows the magnitude of the gains versus the length of it. But old age is not anything that necessarily causes a bull to be in trouble just in and of it by itself, but often price going up coincides with valuations. So if we look at valuations, there's a lot of different ways to look at it. We often say valuations are a blunt tool on the U.S. stock market. Here's Buffett's favorite. He calls it, we call it the Buffett indicator, but this is from D. Short, fellow North Carolinian, who's talking about over time how corporate stocks have done relative to GDP. This chart's from 2017, and if you were to walk it forward to 2020, it's as high as it was at the dot-com boom. And then, of course, my favorite, the 10-year price to earnings ratio, which you can take back to the 19th century. You don't see it on the far right side of this chart, but when 2020 came along, you had a scenario where the CAPE ratio went down to about 22 at the depth of the March bottom, and then has ripped right back up to around 28, which is where we find ourselves at the end of March, which is one of the most expensive in history. Not as bad as it was in late 99 when it hit 45. And notice also, by the way, there's a bunch of periods where it's single digits, like a lot of other countries in the world are right now, just not in the U.S. And we're going to update all of our global valuations in a Zoom Brew webinar, hopefully in the coming days and weeks, where we talk about all the other countries in the world. But the U.S. may or may not be, we'll have to update it, the most expensive country in the world. Again, just valuation doesn't mean that the market has to go down. Here's a great chart from our friends at Star Capital that shows the path of the S&P. Again, this stops in about 2016, and then probable future corridors of returns. And this is like thinking about playing blackjack, back when Vegas used to be open, and you get dealt a 16, the dealer's got a 10, chances are you're going to lose. You should take a hit, and chances are you'll probably bust. But chances are you could, small chance, get a 5 or a 6, get a 20 or a 21, and do okay. And so as we talk about valuations and future returns, is there a chance we could go back up to all-time valuations and do better? Is there chances we could go the worst case scenario? But most likely is where the probabilities lie. In valuations at 2017, as well as again in May 2020, are pretty high, and that puts us at about low single-digit returns. Some would estimate negative, but it's not the historical 10% we talked about. If you guys want to talk about valuations, we've talked ad nauseum on that on other topics. Sentiment was one that is interesting because there's a couple different ways to look at it. And sentiment historically is really only useful at turning points. But this is a unique way to look at it. And this is from Doug Ramsey at Luthold, who looks at sentiment. And this is a survey that goes back to the 1960s. And this is, I think, this is Investors Intelligence. And so he looked at the average of sentiment across an entire year and the subsequent gain in the stock market. And so here on the left table, you have the highest sentiment years where people were really excited about stocks. A lot of times in the 60s, there's a couple sprinkled in there recently, 2014, 2013. You also have, after the first time ever the stock market went up every month in a calendar year, 2017. I think 2019, after the big romp of 30% was in there. But what you find is the next year, returns were terrible. The average return after these big high sentiment years was roughly flat. And if you look at the low sentiment years when no one wanted stocks, the average return in the next year was actually really high. My favorite is the American Association of Individual Investors, which only goes back to the 80s, but it does show at extreme booms and busts that people almost universally get it wrong. And I don't say this is just individuals and retail, it's institutions too. But this chart would ask people, are you bullish, are you neutral, or are you bearish on stocks? And as you can see, the red X's are the average, the blue triangles or where we were in 2017. And we're not that far away from this now, by the way. The bearishness is a little higher, but bullishness and neutral pretty close to the averages. But we can see when it got to full extreme, the worst time in the entire history of this survey to be bullish was January in 2000. That's when the most people were bullish in the entire history. And when were people most bearish? March of 2009. You can't make this stuff up, but it's the exact opposite of what you would want to be. Again, this probably isn't useful 90% of the time, but when the world's going completely crazy, this sort of sentiment can be helpful. And then lastly, we talked about in this 2017, using the Hollywood cliche, it's quiet, almost too quiet, where volatility used to amuse me when you'd see people go on TV during this period and talk about how volatile the markets are. And you're like, what are you talking about? This is one of the least volatile markets in history. In January 2017, the VIX was below 10 for the first time in a decade. And so you can see a chart of, this is from Dr. Duru, but shows the VIX histogram and percentage of time it spends in each area. And below 10 is almost never, which is where we found ourselves, which often means that volatility can be purchased for pretty cheap. Anyway, none of these means that you have to have a market blow up tomorrow, as evidenced by the fact we wrote this paper in 2017. But we wanted to start to think about ideas that if and when the bull market rolled over, that we wanted to understand how we could protect ourselves. So the first part of the study is we say, look, portfolio protection can take many forms. First, you don't have to invest 100% in stocks. If you're someone who's just a big stock picker, the best way to hedge your risk, we always say, is just don't take it in the first place. First thing you can do is say, look, instead of 100%, you could have 80 or 60% and put the rest in cash and bonds, acceptable sleep at night choices. Second, you don't have to limit yourself to U.S. markets. Not the point of today, but again, we think foreign markets are much cheaper, foreign developed, particularly foreign emerging, and within those, the value tilts much cheaper. Doesn't mean that they're not going to get hammered just as bad in a bear market when the U.S. is doing poorly, but over time, expensive markets tend to be much more fragile. Next up is that you can diversify into other asset classes like foreign bonds and real assets like real estate and commodities. Third, you could buy things like liquid alternatives. This is more active strategies, things like trend following and managed futures, long, short, market neutral. And almost everyone's familiar with these three choices to a different degree. And really the fourth one that we'll talk about today is one that's, not for everybody. It's also maybe not for all the time, but if you use it wisely, strategically, it does have the ability to protect a portfolio during drawdowns and potentially actually profit from it. And we'll get in the end of this, we'll talk about how certain investors that are in the financial advisory space, asset management, are actually 2, 3, 4 times leveraged U.S. stocks and don't even know it. So first, we wanted to say what happens in the bad times, and we looked at stocks, the 10 worst months in the S&P since 1980s. On average, U.S. stocks had a minus 11%, almost minus 12% down month. That's nasty. The worst ever, 1987, you lost 21.5%. And by the way, if you took this back to 1900, the average was closer to minus 20. So you got to be prepared for that. Anyway, we looked at these months and we said, what do the other main asset classes do? How do they perform? Do they protect you during these months? And so The ones that you would expect not to protect didn't. So foreign stocks equally as bad. So we look at the average return over these worst months. Batting average is what percentage of the months when the U.S. had a really bad return did the other asset class have a positive? And then we also looked at all negative months. So foreign stocks equally as bad. Commodities weren't helpful. Sometimes they were, but on average, only 40% batting average, not very good. REITs equally as bad, 0% positive when stocks were. And then bonds, that's the big diversifier. People traditionally look for T-bills 100% of the time they helped, but they didn't help much. You only had 20 basis points of returns. That's 0.23%. That's not a huge diversifier. 10 and 30-year bonds helped more. They didn't always help, though, but they had a bigger return when they did. And then gold. Gold had a big batting average, 80%, tied for the strongest return out of all these. The problem is there was 1 month in 2008 when it lost almost 17%. But in general, it does a pretty good job. And then in all negative months, it was actually the highest returner, but it was a coin flip. It was about only half the time. So we then looked at, the actual full bear market. So the last two, August 2000 to the end of 03. We looked 2007, 2009, when essentially you lost 40, 50%. Again, foreign stocks, not helpful at all. Bonds, helpful. T-bills, not as much. Commodities helped in the first, got destroyed in the second. Ditto for REITs. Gold helped in both. So, look, all these ideas I think are useful. And if you actually looked at how assets did this year, we can pull up a chart. This is from Stock Charts and go year to date. And I just used some common ETFs here for the main asset classes. Let's get it to the end of the year. This may be too painful for some people to watch, but let's walk through it. You can see that almost everything puked. This is the fastest ever from all-time high to bear market in the U.S. In history. So in the course of a month, the U.S. lost about a third. And then you've seen this strong rebound. I mean, we're darn close to flat on the year, which is astonishing. And then everything else is kind of junky. You had, again, foreign didn't help. It's actually worse. Real estate worse, emerging markets worse, and then commodities, especially because of oil, got absolutely destroyed. And most commodity indices are energy tilted, heavily weighted. And then on the flip side, look at these two beauties up here. What did well? Bonds did a good job, and of course, gold did a good job too. So the playbook actually worked astonishingly well from our paper in 2007. But also, is there a way that we could apply an active strategy that was defensive and even more offensive when stocks do very poorly? And so we talk about put options here, and I don't want to get into a long disclaimer about what put options are. If you don't understand options, read the paper, walk through it. We'll understand what people do. And we're going to refer to this as a tail risk strategy, which references the statistical distribution curve where extreme events occur in both sides of the tails. No one serious in investment markets I know thinks about a normal distribution, but stocks tend to follow a different distribution where there's a lot of information in the tails. People only usually think of the left tail, which is the bad times, but stock markets have extreme right tail too, where the big returns come from. We love to say, and this isn't my quote, but normal stock market returns are extreme. Even on yearly basis, almost always the returns fall outside of plus or minus 10%. They're the big, huge up years and down years. Anyway, they're almost never average. So what we did, we tried to devise a tail risk strategy for this paper that's hypothetical looking backwards. I spent an entire summer building an options database and then came around to the conclusion we could have just used one of the CBOE indices. You can find these free online. In this case, we did it with CBOE so that people could replicate it. But all it does is it goes and buys 5% out of the money puts on the S&P and then invests 90% of the portfolio in 10-year U.S. government bonds. Super simple. This does it each month. It rolls them. So how did this do, this strategy? This is the same exact table, but with tail risk layered in. Again, we have a fund that does tail risk strategies. I'm not talking about that here. It's broadly related in theory, but not what we're talking about, this hypothetical white paper from 2017. And what you can see is that tail risk does by far the best job of protecting in the worst months. It has big returns, but this is to be expected. This is by design. All negative months does a good job, has a good batting average. And then during the long bears, same thing, incredibly consistent. The best diversifier in 2000, 2003, as well as 2007 to 2009. And the takeaway is clear. Tail risk has produced great, strong, hypothetical relative returns during bad months and bear markets. The problem, of course, is that not all of us can just magically time markets and be market timers and pick bad markets, right? You have to accept the fact that a tail risk strategy is great when time perfect, but what if you allocate prematurely? What's the impact? Because you would have to hold this in the good times too. And I think those are important questions. And so as you think about a tail risk strategy, you have to think about as it's insurance, the same way people think of life insurance, car insurance, house insurance. You're happy to pay for it when you're not using it. And when flat markets, up markets, you're actually going to be paying this premium. And that means, it's going to be a cost to your portfolio during the good times. Flat to rising market, you would expect this allocation to have probably negative returns. My ballpark, when we looked at this historically, is that it actually had positive carry. Now, this was in a world, if you look at this chart, of high 10-year bonds and declining interest rates. So you ended up with a 2% positive carry in this world. But again, bonds probably averaged 5-6% during this period. Well, they're sub 2 now. So you would expect this. You just lop off another 4% to get to where you would probably be today. But anyway, this shows the effects of allocating part of this strategy we dedicate in this paper to traditional S&P 500 allocation. You can see adding a little bit, 20-40%, does a good job of bringing down volatility, but obviously brings down return, brings down the drawdown as well. And then somewhere within there is probably a nice balance of putting both. And if you were to ask some people, they say, look, none of these beat the S&P. I'm fine with the volatility. I'm fine with the drawdown. Leave me alone. I can handle it. That's a totally reasonable response. And for those people, that's fine. But the problem is there's a big difference between the theoretical and the actual. Investors are great at looking back at history, particularly younger ones, and saying, here's my risk tolerance, and then theorizing about how they would behave when their investments lose 25, 50, 75% of their money. And for many, it's not a real experience until they live through it. And so think about how you felt in 2020 as the markets were cratering. Were you totally stoic, agnostic, fine with it? Or were you losing your mind? And so in many cases, having a strategy like tail risk, others like managed futures, trend following, obviously bonds and gold, all did well. If that helps you get to the finish line, if it helps you behave well with the rest of your portfolio, your stocks, your foreign stocks, whatever it may be, private equity, I don't care, then it's a positive. It doesn't have to be an optimal allocation from a purely mathematical standpoint. The older I get, the more I appreciate the behavioral parts of struggles of surviving. The number one compliment we tell people in the investing world is simply not just as an asset manager, but also an investor, is you survive. If you're at a blackjack poker table, you lose all your money, you can't bet. And so the same thing applies with investing. To stay in the game is the most important thing. And so again, we wrote this in 2017. I think the concepts of tail risk that everyone's discussing today, I don't think it matters exactly how you do it, but the concepts of having something that allows you to walk through the possibilities, I think is really useful. And there's one, we'll skip the Appendix A, but Appendix B, I think is really useful. And then it's a final note to advisors. And I've disclosed many times, we have a post called How I Invest My Money. You can find it, that I put a significant chunk of my public portfolio into tail risk strategies. We put an even bigger chunk of my company's balance sheet into tail risk strategies. And let me illustrate why. Now, let me give this a caveat. I don't think anyone else on the planet believes this the way that I do. Okay, so it's a different way of thinking. Now, other corporations and people think about risk this way, in the sense that an airline will hedge its fuel cost. A cereal company will hedge the cost of wheat. So other people think of risk just when it comes to investing. Some reason a lot of people don't. So for an example, let's say you're an advisor at Morgan Stanley or an investment advisor, you own your own business, you're probably 4 times leveraged to the US stock market. First is you own stocks in your own personal portfolio. Even if it's diversified stocks and bonds, the volatility of stocks swamps those of bonds. 2, your business revenue, if you're a fee-based advisor, is directly related to the level of stock market. If the stock market goes down 50%, your revenue just went down 50%. So your human capital directly related to the stock market. The longer term business revenue, because investors often will panic and sell. If you got great clients, good for you. But often clients of all stripes will panic and sell what they can during the bad time. So even if you're doing a good job, you may get liquidated. So your business revenue may be impacted. And on top of that, if you don't own your own business, your company may do layoffs. So there's an argument to make that advisors and asset managers not only shouldn't have a lot in US stocks, you could argue they could have none. You could even argue that they should have a negative beta or exposure to stocks. Now, most people aren't that crazy, but walk through that exercise. Now, walk through 2020 and think about how it felt as you experienced 2020. At the very least, it's a useful mental exercise. It's a little fun. And we showed this in 2017. We said, look at the revenue of asset managers during the financial crisis. Most of them got destroyed. Look at their stocks. The stocks got destroyed. So I don't even want to talk about the fifth leverage that people would have that work for these companies, which is investing in their stocks in their retirement plan, which is like one of the dumbest things you can ever do. Ask anyone at Enron. Anyway, guys, kind of winding this down, this investing business, we spend so much time thinking about optimizing and what's most useful, how to think about the perfect portfolio, what's the portfolio that's the most optimal with mean variance or whatever it may be. But having the pieces that put together that, again, can help you finish the race, sustain the hard times. And again, if you look back at 2020, we wrote a piece called Investing in the Time of Corona. I don't think it was at all clear that the bull case would have transpired, which was what we've had. We outlined a bear case that seemed very plausible and possible at the time. And who knows what will happen the rest of 2020 and beyond. Could be a scenario where we go right back down. This comes back in the fall like it did during the Spanish flu in the early part of the 20th century. Knock on wood, I hope not. Hope we get a vaccine and this sort of disappears into the ether, but you at least have to walk through the possibilities. And in the case when you have a stock market like the US, one of my most popular tweets recently is I said, look, if I were to go back in time 12 months ago and tell you, look, over the next year, unemployment's going to go from 4% to 15, maybe 20 now. Purchasing Managers Index is going to go from expansion to one of the biggest contractions ever. You're going to have gold ripping. You're going to have interest rates, Fed go from 2.5 to 0, and you're going to have oil going down 70%, futures trading at negative. Where would you peg the stock market? And I think most people would say down 30, 50, 80. And I'll tell you, would you believe me if I said it would be up over that period? And so walking through the potential outcomes and the possibilities. Again, the summary of this is not panic and sell everything, and it may not be sell any stocks at all, it may not be hedge at all. But the challenge is walking through it. Are you capable of withstanding Great Depression scenario where stocks lost 90%? Or even a mild 50% like we've had in the last two. And by the way, many asset classes like small cap value were down 50% at one point this year already. Anyway, people, friends, think about it. Hopefully everyone's watching the launch this weekend and it goes great. We're going to have a lot more discussions coming up on tail risk and everything else. Thanks for listening, friends, and good investing.
Matt Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.